Hello, welcome to the Credit Compass, helping you navigate the world of European credit, where we break down the biggest moves in credit markets, macro trends, and fixed income strategies, shaping the financial landscape in Europe and the UK. My name is Gordon Kerr, European macro strategist and host. In this episode, we will cover the recent market volatility surrounding the US tariff announcement starting last week and what it means for credit and for Europe. Further to that, I have two of my colleagues from KBRA DLD, Eric Rosenthal and Rachel McGovern. They will give us an update on their newly launched KBRA DLD Europe Index, which covers default rates in European private credit. All right, let's dig in. On the 2nd of April, the US administration announced a large-scale implementation of tariffs on countries across the globe. The market has reacted negatively, with equity markets migrating into bear market territory in the US. In Europe, they have corrected as well, but have yet to fall into bear market territory for the year, given the position European markets were starting from. However, they have now turned negative for the year to date, reversing those strong early gains. In the world of credit, spreads have widened out rapidly to levels last seen in 2023. Prior to the 2nd of April, European spreads remained in a reasonable range and still inside of 2024 levels. They are still a long way off the recent highs within 2022, but have rapidly headed in the wrong direction, at least as of the recording of this podcast. The reaction within governments in Europe has been measured so far. Ursula von der Leyen highlighted that Europe remains laser-focused on two things. One, the 83% of trade that Europe does outside of the US, focusing on improving their relations with other economies and expanding trade deals with many countries and diversifying away from the US. Second, they are focused on removing barriers to improve trade internally within Europe and improving the advantage of the European Union and creating greater integration. As of now, Commission discussions are ongoing with industry on how best to respond should tariffs go ahead, and where they could respond in a measured way. The reaction from strategists ranges from discussion about stagflation or recession within the US, and you can see my colleague Van Hesser's comments on that on his podcast and newsletter. For Europe, it is difficult to fully decouple the outlook for the US economy from any impact to Europe. Investment analysts suggest an impact range from 0.3% to 1% of GDP, both in the Eurozone and in the UK. Given how low growth was initially expected to be, it would keep growth in Europe very muted and bordering on recession as well. While the current tariff tantrum remains a challenge for markets, ongoing negotiations with the US administration will determine the full economic impact. So while the market could still fall further and the second quarter could be a real challenge economically, the longer-term impact of this could be a positive for Europe as it looks to move forward on elements of the European agenda that have long been overdue. All right, now turning to my colleagues joining me today, we have Rachel McGovern, who heads KBRA DLD in Europe.
Hello, thanks for having us, Gordon.
And we also have Eric Rosenthal, who tracks defaults and implied recoveries for both the US and Europe. They have a quarterly report for Europe that KBRA DLD has recently published and is proving to be very timely as the tariff threat starts to roil market expectations for credit in the year ahead. So let's start with you, Eric. For those who do not know you yet, you joined KBRA DLD 2 years ago and have been publishing your tracking and forecasting of defaults in private credit in the US. Now you have recently launched a similar quarterly report in 2025 for Europe. Give us a bit of background on the KBRA DLD Europe Index and outline what your 2025 default forecast for Europe is versus how we fared in 2024.
Sure, and thanks for having me on the podcast. We're calling for a 1.25% default rate by volume for 2025, and that's up from 0.4% in 2024. On account basis, we anticipate a 2.25% default rate, climbing from 1% in 2024. Now, the higher 2025 default forecast, that stems from a growing number of issuers on default radar with red status. These are viewed as the most worrisome credits. Also, our overall fair value marks declined versus the previous quarter. The consumer sector, that likely drives the 2025 rate by count. Now for our index, we have approximately 290 European companies and 18 billion of private loans that reflect the broader direct lending market. And roughly 70% of that sample, that involves either a UK, France, or a Germany-based borrower, with sponsored issuers accounting for about 90% of our index. Borrowers with syndicated debt, those are excluded. Now, the European index is based on the holdings of US registered BDCs, which are required to disclose schedules of investments quarterly. This provides important visibility into an otherwise opaque marketplace, even though that sample is significantly smaller than the roughly 2,500 borrowers that are found in our US index. Now, when you compare the 2025 US forecast to that of Europe, we have a pretty similar default rate by volume at 1.25%, but we have a higher count at 3%. Now, our US report, that's published on a monthly basis with weekly commentary and real-time news coverage.
Great. Thank you, Eric. That seems rather low in comparison to what the markets are telling us at the moment. But anyway, Rachel, let's turn to you for your thoughts on the way that the tariff threat is impacting upon private credit.
Well, I suppose the first thing is we've seen a complete U-turn in terms of sentiment from the market. After Donald Trump's election, there was an optimistic vibe, kind of driven by the belief that Trump would, to rob a phrase, make M&A great again. Now, obviously, the markets are convulsing in the wake of the tariffs, and that uncertainty means the gap between buyers and sellers, which had been narrowing, is going to burst wide apart again. We're already hearing about pulled processes all over Europe, including one advisor who lost 2 deals just last week. But if we look at it through the context of defaults, it's actually much less of an impact. So direct lenders will turn their focus to refinancing, and the chaos as it drags on, if we fall into a global trade war, the impact will be felt by some of the businesses within our index, but that's going to take time to filter through. When we look at the year ahead, it's companies already in trouble that we're most concerned about. The 2024 defaults, there were 2 clear trends within that cohort. The first is the obvious. 2017 vintage deals, often in the consumer sector, that underperformed and finally hit the maturity date. The sponsor sees no way of recovering their own investment from a sale and then ends up handing the keys over to the lender. The other restructurings we saw were 2021 and 2022 vintage deals. These were executed at the height of the COVID lockdowns for businesses that were buoyed up by the impact of the pandemic and sold at high valuations. If you think of online shopping, whether it's Seller X, the Amazon aggregator, or an online garden retailer based in Germany that used its private equity investment to buy a string of other similar businesses across Europe. Problem is, we're not all locked in our homes anymore buying giant garden chest sets or offices for our gardens. And those companies have struggled to perform, and lenders have gone in early in taking the keys. We think our most likely candidate to be the first restructuring from within our index in 2025 is part of that same trend. CVC Capital Partners are in discussions to hand control of away resorts to its private credit lenders. It's a UK-based holiday park operator and caravan seller that the sponsor bought back in 2021. They even put in fresh capital last year to cure a covenant breach, but they're now calling time on that deal. And this is where we'll see the stress immediately in 2025. Tariff impacts on a default scenario are much further out.
Thanks, Rachel. Now, Eric, given what Rachel has just highlighted and the prospect for some companies to tip over, how do the implied recoveries look for 2025?
Right, so Gordon, I wish I could give you kind of a more optimistic outlook, but we're projecting a 40% implied recovery, which is kind of in line with what we saw for 2024 based on a relatively small sample. Now, implied recoveries, those are based on the fair value marks provided by the BDCs. The average fair value mark for default radar red issuers is at 61.8%, but that level declined by more than 16 points in the past 6 months. We expect that downward trend to continue as defaults eventually happen.
Great. Thank you very much, both Rachel and Eric, for your insights. Be sure to reach out and sign up to DLD for future insights across private credit. And of course, check out KBRA.com for further research across a broad range of topics. That's all for today, and thank you again for tuning in to the Credit Compass. Don't forget to like, subscribe, and share the podcast with colleagues and friends. And we look forward to speaking with you again soon. As always, staying informed is key to navigating the complexities of the markets today. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.